Most people don't lose money because they pick the wrong assets. They lose it because nobody taught them the rules of the game until it was too late. And in this video, we are going to look into the 7 lessons many people learn too late in investing. The number one lesson is that starting small is better than waiting to start big. A lot of people think the best time to start investing is when their salary increases. They are waiting for the perfect moment or when the market will dip before they can invest. But the problem is that nobody knows when those days are coming. They often show up right after the scariest crashes, when most people are too afraid to be in the market at all. For example, take the gold and silver market crash of January. A lot of people didn't know that the market would collapse. In fact, some were predicting that gold would hit a certain price level. How about the stock market? Since the start of 2026, the market has been fluctuating, rising this week, dipping the next. If you're waiting for the market to stabilize before you invest, you might end up waiting all year and still miss some of the market's best performing days. This hesitation is exactly why ordinary people who invest consistently month after month, regardless of what the market is doing, often beat the investors who are constantly watching, waiting, and overthinking. That's because markets rarely move in straight lines, and trying to pick the perfect entry often means missing the moments that actually matter. In essence, starting early, even with small amounts, always beats waiting for the right opportunity. The reason is because of the power of compounding. The money you invest earns returns, and when you reinvest those returns, they earn even more. For example, imagine someone who invests $100 every month starting at the age of 22 into a stock market ETF. Another person waits until the age of 35 but invests $300 monthly. Even though the second person invests more each month, the one who started earlier often ends up with more returns, simply because their money had more time to grow. And here's something most people miss. If you try to time the market, you can easily miss just a handful of the best days. And missing those few days can seriously reduce your long-term returns. So you don't need to start big. You just need to start early. Because in investing, time does what money alone cannot. The number 2 lesson is that not investing is also a decision, and a costly one. A lot of people think doing nothing with their money or putting it in a savings account is the safest option. It might feel good as there is no risk, no loss, no stress. Just cash sitting quietly in a bank account, untouched and protected. But here's what they don't realize. That money is already losing value. When your money sits idle for years, inflation quietly reduces its value. Prices rise, rent increases. Food becomes more expensive. What $100 could buy 10 years ago cannot buy the same things today. And the same is true for $1,000. So even if your money is safe in a bank or under your pillow, it is slowly losing purchasing power. The reason is that central banks print more money to inject into the economy. For example, the U.S. Federal Reserve prints and creates new money, often to buy government debt and help the government fund its spending needs. Many countries are heavily in debt, and borrowing more money increases the money supply in circulation. When more money is printed and enters the system, each unit of currency becomes less scarce. And when money becomes less scarce, its value drops, which leads to higher prices. So while you may think you are protecting your money by not investing, inflation is quietly reducing its strength year after year. You might think that avoiding the market might feel like avoiding risk, but you're simply choosing a different type of risk, the risk of falling behind. While others allow their money to grow through compounding, dividends, or business expansion, the person who refuses to invest misses those opportunities entirely. And time doesn't pause while you decide when to invest. The third lesson is consistency beats intelligence. Many people believe you need to be extremely smart to succeed in investing. They think you must predict market crashes, pick the perfect stocks, or understand every economic headline. But the truth is simple. Consistency beats intelligence. You don't need to outsmart the market. You just need to outlast it. There are highly intelligent people who constantly analyze market charts, jump in and out of investments, and try to time every move. Yet ordinary investors who simply invest the same amount month after month, year after year, outperform them. Why? Because consistency removes emotion. It removes overthinking. It removes the pressure of being right all the time. For example, think about someone who invests $200 every month into a dividend-paying ETF with an average annual return of 10%. In 10 years, how much do you think that steady habit would be worth? That's the power of consistency and compounding, working quietly in the background. And remember, this doesn't even include the dividend income he may be receiving quarterly without stress. And as the investment grows, the dividend payments would also grow. Now imagine he keeps reinvesting that dividend income instead of spending it. What would his account balance look like after 10 or 15 years? That is how wealth is built. Not through intelligence alone, but through disciplined, repeated action. The fourth lesson is that diversification isn't just owning more stocks. Many times people claim their portfolio is diversified simply because they own multiple stocks. You'll hear them say things like, "I don't own just one company, I own 5 different stocks." But the truth is, owning several stocks doesn't automatically mean you're truly diversified, because if all 5 are in the same industry, the same country, or the same type of asset, that's not true diversification. That's concentration wearing a different outfit. The truth is that diversification isn't just about quantity, it's about balance. You need to spread your investments across different sectors, different industries, and even different asset classes like stocks, bonds, real estate, or international markets. Because when one area struggles, another may perform better. For example, tech stocks are known for massive rallies, and in this era of AI, companies like NVIDIA have experienced explosive growth. And because of that, sector-based ETFs like QQQ, which are heavily weighted toward technology, have also surged because they benefit directly from the AI boom. But here's the other side of the story. When the stock market experiences a sharp decline, these same tech-heavy investments often fall faster than the broader market. In essence, the same sector that rises quickly during excitement can drop just as quickly during fear. That's why diversification is so important. Because when all your money is tied to one sector, like the tech sector, your portfolio can rise fast, but it can also fall just as fast. But when you spread your investments across different sectors, asset classes, or even include real estate and precious metals like gold and silver, you reduce the damage a downturn in one sector can cause to your overall portfolio. In essence, diversification doesn't just eliminate risk, it manages it. Because the goal isn't just to grow fast in good times, it's to survive the bad times and keep growing long term. The number 5 lesson is that high returns usually come with high risk. Normally, everybody loves the idea of high returns because the goal is to build wealth. That's why when you hear that an investment doubled in a year or that someone made 200% in a short time, it sounds exciting. It feels like an opportunity. It feels like freedom. But what many people learn too late is this. High returns almost always come with high risk. Take the crypto market as an example. It is known for massive rallies that offer life-changing gains in short periods. During bull runs, it feels unstoppable. People rush in because they don't want to miss out, but they fail to remember that the crypto market is highly volatile. For instance, since the October 2025 market crash, the crypto market has witnessed significant drops. Those who invested near the highs are currently sitting at losses. What looked like a rally has turned into uncertainty, fear, and regret for many investors. This is the reality of high-return assets. The upside is exciting, but the downside can be painful. When prices are rising, risk feels small. When prices are falling, risk feels very real. Remember, this doesn't mean crypto is bad. It means volatility is the price you pay for the possibility of higher returns. So, before chasing high returns, ask yourself this question. Can I handle the downside if this goes wrong? Because in investing, the higher the potential reward, the greater the potential volatility. The 6th lesson is failing to know that debt and fees can destroy your investment progress. The reality today is that many people focus on how much they can earn from investing and ignore how much they are losing to debt and hidden fees. But the truth is, you cannot build wealth efficiently while high-interest debt is draining your cash flow. For example, imagine earning 8 to 10% annually from your investments, but paying 20 to 30% interest on credit card debt. The math is already working against you because before your investments can grow, your debt is already compounding faster in the opposite direction. In essence, debt with high interest is like trying to fill a bucket with water while there's a hole at the bottom. No matter how much you pour in, it keeps leaking out. What about fees? Fees work the same way, but just more quietly. Management fees, transaction costs, and high expense ratios may look small, 1% or 2%, but over 10 or 20 years, they can reduce thousands from your total returns. Because fees compound too. So what is the lesson here? Smart investing is not only about chasing higher returns, it's about reducing what is working against you. So before increasing your investments, fix expensive debt. And always understand the fees you're paying, because what you keep matters just as much as what you earn. The seventh lesson is failing to understand that wealth building is boring. Let's be honest, real wealth building is not exciting. For example, the crypto market can deliver fast gains. One week, the Bitcoin price is pumping. Social media is loud with excitement. Influencers are posting screenshots of massive profits. Suddenly, everyone sounds like a market analyst, confidently projecting unrealistic price targets. At that point, you start to feel the urgency to invest so you don't miss out on the rally. But that excitement usually comes with sharp drops, sudden panic, and sleepless nights. In a matter of minutes, billions can be wiped out from the market. The joy that once filled social media quickly turns into fear and regret. What felt like easy profits can disappear almost as fast as they came. Now compare that to ETFs, index funds, or mutual funds. They don't double overnight. They don't trend on social media. They grow slowly, steadily, almost quietly, month after month, year after year. What about real estate? A property may take years to appreciate significantly, but over time it can generate strong returns and consistent cash flow. That's the pattern you'll notice across the most reliable wealth-building assets. They require time, patience, and repetition. They don't usually create overnight millionaires. They create disciplined investors who stay committed for years. Remember, excitement can come and go. Markets can surge today and crash tomorrow. Trends can rise quickly and fade just as fast. But steady growth, compounded over decades, quietly builds real financial freedom. Now, you know the 7 lessons people learn too late in investing. Remember, this video is not financial advice. It is only for educational purposes. Investing is risky and can wipe out your portfolio if you don't know what you are doing. Always do your own research before investing, and do not invest what you cannot afford to lose. If you found this video helpful, like, share, and subscribe. Thank you.